was held in the backdrop of an early and promising start of the monsoon season. This is of vital significance for the Indian economy. In contrast, the global backdrop remains fragile and highly fluid. The uncertainty around the global economic outlook has somewhat ebbed since the MPC met in April in the wake of temporary tariff relief and the optimism around trade negotiations. However, it is still high to weaken sentiments and lower global growth prospects. Accordingly, global growth as well as trade projections have been revised downwards by multilateral agencies. Moreover, the last mile of disinflation is turning out to be a little more protracted. As growth inflation trade offs is becoming more challenging, monetary authorities are charting out a more cautious and carefully calibrated policy trajectory. Looking beyond the near term, growing economic and financial fragmentation is reshaping the global economy. Besides complex interconnections with the financial system, elevated debt levels, and growing influence of frontier technologies like AI are raising financial stability concerns. Amidst heightened volatility in capital flows and exchange rates, coupled with constrained policy space, central banks of emerging market economies have a tougher task to stabilize their economies against global spillovers. In this global milieu, the Indian economy presents a picture of strength, stability, and opportunity. First, strength comes from the strong balance sheets of the five major sectors: corporates, banks, households, government, and the external sector. Second, there is stability on all three fronts: price, financial, and political, providing policy and economic certainty in this dynamically evolving global economic order. Third, the Indian economy offers immense opportunities to investors, both domestic and foreign, through three Ds: demography. We have a high proportion of the working age population which is growing. It is becoming more literate, it's becoming more educated, more skilled, urbanized. Then there is the third D, the second D, the digitalization. We have very advanced and sophisticated public digital infrastructure. And domestic demand is the third D, which we are talking about over here, which is very important given the trends of deglobalization. This 5x3x3 matrix of fundamentals provides the necessary core strength to cushion the Indian economy against global spillovers and propel it to grow at a faster pace. We are already growing at a very fast pace. 6.5% is the highest, not only last year amongst major economies, but even in the last decade. Of course, we aspire to grow at a higher rate, and we are making all efforts in our vision of a Viksit Bharat by 2047. I now come to the Monetary Policy Committee decisions. The Monetary Policy Committee met on the 4th, 5th, and 6th of June, that is today, to deliberate and decide on the policy repo rate. And after a detailed assessment of the evolving macroeconomic and financial developments and the economic outlook ahead, the MPC decided to reduce, which is widely expected, the policy repo rate under the liquidity adjustment facility by 50 basis points to 5.5%. I repeat, the reduction recommended by the MPC is for 50 basis points to 5.5%. This is with immediate effect. Consequently, the standing deposit facility rate, which is the STF rate, shall stand adjusted to 5.25%. And the marginal standing facility MSF rate and the bank rate shall stand adjusted to 5.75%. I shall now briefly set out the rationale for these decisions. Inflation has softened significantly over the last 6 months from above the tolerance band in October 2024 to well below the target. Its latest numbers are 3.2%, with signs of broad-based moderation. The near-term and the medium-term outlook now gives us confidence of not only a durable alignment of headline inflation with the target of 4%. You are aware we had earlier projected for this year an average inflation of 4%, as excluded in the last meeting, but also the belief that during the year it is now likely to undershoot the target at the margin. While food inflation outlook remains soft, core inflation is also expected to remain benign, with easing of international commodity prices in line with the anticipated global growth slowdown. The inflation outlook, therefore, for the year is now being revised downwards from our earlier forecast of 4% to 3.7%. Growth, on the other hand, remains lower than our aspirations amidst challenging global environment and heightened uncertainty. Thus, the MPC felt that it is imperative to continue to stimulate domestic private consumption and investment through the policy levers to step up the growth momentum. This changed growth inflation dynamics calls for not only continuing with the policy easing, but also the MPC felt front-loading the rate cuts to support growth. Accordingly, the MPC voted to reduce the repo rate by 50 basis points to 5.5%, as already mentioned. After having reduced the policy repo rate by 100 basis points in quick succession since February 2025, the Monetary Policy Committee also felt that under the present circumstances, monetary policy is now left with very limited space to support growth. Hence, the MPC also decided to change the stance from accommodative to neutral. From here onwards, the MPC will be carefully assessing the incoming data and the evolving outlook to chart out the future course of monetary policy in order to strike the right growth inflation balance. The fast changing global economic situation too necessitates continuous monitoring and assessment of the evolving macroeconomic outlook. I will now come to the assessment of growth and inflation. First, growth. The provisional estimates released by the National Statistical Office placed India's real growth in 24-25 last year at 6.5%. During 25-26 so far, domestic economic activity has exhibited resilience. Agriculture sector remains strong with a very good harvest in both the Kharif as well as Rabi cropping seasons. The supply of major food crops is comfortable. The reservoir levels remain healthy. The highest procurement of wheat in the last 4 years provides a comforting stock position. Industrial activity is gaining gradually, even though the pace of recovery is a little uneven. Services sector is expected to maintain momentum. PMI services stood strong, as you are aware, at 58.8 in May 2025, indicating a very robust expansion in activity. On the demand side, private consumption, which is the mainstay of aggregate demand, about 56% of the total GDP, remains healthy with a gradual rise in discretionary spending. Rural demand remains steady while urban demand is improving. Investment activity is reviving as reflected by high frequency indicators that we track. Merchandise exports recorded a strong growth in April 2025. Of course, this could be because of some front loading, but this is after a lackluster performance in the recent past. Non-oil, non-gold imports posted a double-digit growth, reflecting buoyant domestic demand conditions. Services exports continue on a very strong growth trajectory. Both the last month's figures have been quite robust. Going forward, the outlook for agriculture sector and rural demand is expected to receive further impetus by the expected above normal southwest monsoon rainfall. On the other hand, sustained buoyancy in services activity should nurture revival in urban consumption. The healthy balance sheets of banks and corporates, governments continue to the government's continued thrust on capex, elevated capacity utilization, improving business optimism, and easing of financial conditions should help further revive investment activity. Trade policy uncertainty, however, continues to weigh on merchandise exports prospects. The conclusion of the free trade agreement with the United Kingdom and the fast progress that is being made in our negotiations with other countries, on the other hand, should provide a fillip to trade. Spillovers emanating from protracted geopolitical tensions and global trade and weather-related uncertainties pose downside risks to growth. Taking all these factors into consideration, real GDP growth rate for this year 25-26 is projected at 6.5%. We continue with our earlier forecast with Q1 at 6.5, Q2 at 6.7, Q3 at 6.6, and Q4 at 6.3%. The risks are evenly balanced. I will now move to inflation. CPI headline inflation continued its declining trajectory in both March and April. The headline inflation moderated to a nearly 6-year low, in fact 69 months to be precise, to 3.2% in April 2025. This was led mainly by food inflation, which recorded the 6th consecutive monthly decline. Fuel group, which had been earlier witnessing deflationary conditions, there was a reversal of the deflationary conditions, and it has recorded positive inflation prints in the last 2 months of March and April. This is partly because of the hike in LPG prices. Core inflation remained largely steady and contained during March and April, and this is despite the increase in gold prices, which exerted an upward pressure. The outlook for inflation provides towards benign prices across major constituents. The record wheat production and higher production of key pulses in the Rabi crop season should ensure adequate supply of key food items. Going forward, the likely above normal monsoon, along with its early onset, augurs well for Kharif crop prospects. Reflecting this, inflation expectations are showing a moderating trend, and this is more so for the rural households. Most projections point towards continued moderation in prices of key commodities. This includes crude oil, which is of critical significance to us. Notwithstanding these favorable prognoses, we need to remain watchful of weather-related uncertainties and the still evolving tariff-related concerns with their attendant impact on global commodity prices. Taking all these factors into consideration and assuming a normal monsoon, CPI inflation for the financial year 25-26 is now projected at 3.7%. As I mentioned earlier, this is a downward revision from our earlier forecast of 4%. We are projecting inflation for Q1 at 2.9%, Q2 at 3.4%, Q3 at 3.9%, and Q4 at 4.4%. The risks are evenly balanced. I'll now come to the external sector. With a moderation in trade deficit in Q4 24-25, alongside strong services exports and remittance receipts. The current account deficit for last year 24-25 is expected to remain low. We are yet to get the final figures. Furthermore, despite rising geopolitical uncertainties and trade tensions, India's merchandise trade remained robust in April 2025 as imports grew faster than exports. Trade deficit, however, widened during the month, which is the month of April. Going forward, net services and remittance receipts are likely to remain in surplus, counterbalancing the rise in trade deficit. The current account deficit for this year, 25-26, is therefore expected to remain well within the sustainable levels. On the financing side, in 24-25, foreign portfolio investment to India dropped sharply to 1.7 billion US dollars, as foreign portfolio investors booked profits in equities. Net foreign direct investment, FDI, too moderated. I would like to take a moment over here because there has been large and widespread commentary on this moderation of net FDI. Now, we look at net FDI primarily because of our concern regarding foreign exchange reserves, where the net becomes important. It's not only the net the inflows, but also the outflows, which actually lead to either an accretion or a depletion in the foreign exchange reserves. However, when it comes to investment, then it is the gross FDI which is actually important, and gross FDI last year actually increased quite sharply. 14% is a very robust growth that we had, 81 billion US dollars. And so India continues, therefore, to be an attractive investment destination, despite there being a moderation, as we are seeing in net inflows, which is primarily because of rise in repatriation, which is again which is a very good sign of a maturing market, where foreign investors can enter and exit smoothly, and at the same time higher gross FDI, which is again a sign of our large industrial and other companies going out and investing. So on the whole, gross FDI is high, which indicates that there continues to be a good and attractive investment. External commercial borrowings and non-resident deposits, on the other hand, witnessed higher net inflows compared to the previous year, as on May 30, 2025, India's foreign exchange reserves stood at 691.5 billion US dollars. These are sufficient to fund more than 11 months of goods imports and about 96% of external debt outstanding. Overall, India's external sector remains resilient as key external sector vulnerability indicators continue to improve. We remain confident of meeting our external financing requirements. Now I come to liquidity and financial market conditions. You are all aware that the RBI over the last few months, in fact since January, we have injected a lot of durable liquidity through various means, through OMOs, through the CRR rate cut, through the buy-sell swaps, OMOs, etc. A total of 9.5 lakh crore rupees of durable liquidity has been injected into the banking system since January. As a result thereof, after remaining in deficit since mid-December, liquidity conditions have transitioned to a surplus at the end of March. And this is also evident from the tepid response to the daily VRR auctions, which got a bid coverage ratio of only 0.26 in the recent past, and also from the high STF balances. They are averaging about 2 lakh crore rupees in the last 2 months, that is April and May. Similarly, reflecting the improvement in liquidity conditions, the weighted average call rate, which is the operating target for the monetary policy, this traded at the lower end of the LAF corridor since the last policy. The comfortable liquidity surplus in the banking system has further reinforced transmission of policy repo rate cuts to the short-term rates. However, we are yet to see a perceptible transmission, although there are incipient signs of transmission to the credit market segment, but it is still not perceptible. Although we are aware, and we need to keep in mind that it does happen with some lag. The Reserve Bank remains committed, as we mentioned earlier, to provide sufficient liquidity to the banking system. To further provide durable liquidity, it has now been decided to reduce the cash reserve ratio, the CRR, by 100 basis points. I repeat, we have decided to reduce the cash reserve ratio by 100 basis points from 4% to 3% of net demand and time liabilities. This will be done in a staggered manner during the course of the year in 4 equal tranches of 25 basis points each, coming into effect from the fortnights beginning September 6, October 4, November 1, and November 29 of this year, which is 2025. The cut in CRR would release primary liquidity of about 2.5 lakh crore rupees to the banking system by the end of November 2025. Besides providing durable liquidity, I would like to emphasize over here and highlight that it will also reduce the cost of funding of the banks, thereby helping and accelerating the monetary policy transmission to the credit market. I would like to reiterate that we will continue to monitor the evolving liquidity and financial market conditions and proactively take further measures as may be necessary for liquidity and for monetary policy transmission. I will now come to financial stability. The system level financial parameters of the scheduled commercial banks continue to be robust. The asset quality parameters, liquidity buffers, and profitability parameters have shown further improvement. The credit deposit ratio for the banking system at the end of December 2024 was at 81.84%. This is broadly similar to what it was a year ago. Similarly, the system level parameters of NBFCs are sound with comfortable capital position and improved GNPA ratios. The stress witnessed earlier in retail segments like unsecured personal loans and credit card receivables portfolio has abated, while the stress in microfinance segment is still persisting. Banks and NBFCs active in these segments, however, are already recalibrating their business models, strengthening their credit underwriting practices, and stepping up their collection and recovery efforts to avoid any excessive buildup of risks on this front in future. I now come to the end of my statement. On both inflation and growth fronts, the Indian economy is progressing well, and it is broadly on expected lines. And this is despite the huge uncertainty that the global uncertainty that we have. Strong macroeconomic fundamentals and benign inflation outlook provide space to monetary policy to support growth while remaining consistent with the goal of price stability. As global environment remains uncertain, it has become even more important to focus on domestic growth amidst sustained price stability. Accordingly, today's monetary policy actions should be seen as a step towards propelling growth to a higher aspirational trajectory. Here, I would also like to highlight that there is no tussle between price stability and growth in the medium and long term. Price stability preserves purchasing power, it imparts certainty to households as well as to businesses in their savings and investment decisions, and it ensures congenial interest rate and financial conditions, all of which foster consumption, investment, and overall activity and therefore growth. Moreover, this is crucial for equitable growth and shared prosperity because its absence is disproportionately burdensome on the poor. I must also add over here that while price stability is a necessary condition, it is of course not sufficient to ensure growth. A supportive policy environment is vital. And this is even more important during periods of high uncertainties, such as the current times that we are witnessing. At the Reserve Bank, therefore, while price stability remains the focus of monetary policy, we are not oblivious to putting in place complementary monetary as well as credit policies and regulations that support growth and prosperity. Thank you, Namaskar, and Jai Hind.